Joint venture. Joint operation. If you've ever mixed those two up, you're not alone. They sound almost the same, but for accounting purposes they're treated completely differently. In the next few minutes, I'll show you exactly where the line sits between the two, using a story, not jargon. Let's get into it. By now our founder runs 3 cafes under one brand. Business is steady, but she's paying a premium for pre-roasted beans from an outside supplier. She starts dreaming of roasting her own beans in-house. Better margins, better quality control. Problem is, proper roasting equipment costs more than she wants to carry alone. So she calls up an old friend, Nadia, who runs her own small chain of cafes across town. Nadia has been thinking the exact same thing. They agree to team up. 2 founders, 1 roasting operation. But how they structure that partnership is about to matter a lot more than they realize. Option 1. They simply buy a roasting machine and a small warehouse together, in both their names. No new company, just shared equipment, shared costs, and shared output, split down the middle. Option 2. They set up a brand new company altogether, BrizoRoast, each owning 50% of it. BrizoRoast owns the machine, hires the roaster, and sells beans back to both cafe chains. Same 2 founders. Same 50-50 split. Same roasting outcome. But one of these is called a joint operation and the other a joint venture. And it's not simply about whether a company got set up. So what actually separates the two? Let's break it down. Under the accounting rules for joint arrangements, there are only 2 flavors: a joint operation and a joint venture. In a joint operation, each party has rights to the assets and obligations for the liabilities, whether or not there's a separate company sitting in the middle. You own a slice of the actual oven, the actual beans, the actual bills, not just a stake in a business. In a joint venture, the parties only have rights to the net assets of the arrangement, what the whole thing is worth, not to its individual assets and liabilities. This is usually done by setting up a separate company. But here's the catch. Simply setting up a company doesn't automatically make it a joint venture. So if incorporating a company doesn't automatically decide it, what actually does? There are 3 things you have to check. First, the legal form of the vehicle itself. Most companies legally separate their assets and liabilities from their shareholders. That points toward a joint venture. But some structures, like a general partnership without separate legal personality, don't create that separation at all. Even though it's a named, separate vehicle, the partners directly own its assets and directly owe its debts, and that points toward a joint operation. Second, the contract terms. Even with a proper company in place, the shareholders' agreement can override that separation. If it says each founder personally guarantees the company's debts, or gives each founder rights to specific assets the company holds, that pulls it back toward a joint operation. Third, other facts and circumstances. If the company is designed to sell almost all of its output back to the 2 founders at cost, with no profit margin of its own, and the founders must keep funding it whenever it runs short of cash, that's a strong sign the founders are really using the company to access the roasting operation directly, not investing in an independent business. That again points toward a joint operation. So even with a company in the middle, you always come back to the same underlying question. Do the founders have rights to the assets and obligations for the liabilities, or only a claim on what the company is worth? In a joint venture, the parties only have rights to the net assets of the arrangement, meaning rights to what the company is worth, not to its individual assets and liabilities directly. Because the rights are different, so is the accounting. For a joint operation, each party recognizes its own share of the assets, liabilities, revenue, and expenses, line by line, in its own books. It's almost like a mini consolidation slice, half the oven, half the beans on hand, half the roasting costs, sitting directly in each founder's own financial statements. For a joint venture, it works completely differently. Neither founder puts half the oven in her books. Instead, she books a single line, investment in BrizoRoast, using something called the equity method. That one line moves up and down each year based on BrizoRoast's own profits and losses, but the individual assets and liabilities of BrizoRoast never appear directly in either founder's books. So back to our two founders. If they'd simply bought the machine and warehouse jointly, no separate company, direct rights to the asset and the bills, that's a joint operation. They actually incorporated BrizoConsol Pte Limited, so we run the 3 checks. Its legal form is an ordinary company, which separates its assets and liabilities from its shareholders. Its shareholders' agreement has no guarantee clauses and gives neither founder rights to specific assets. And BrizoConsol sells beans to both chains at a normal market margin, not at cost, and isn't dependent on the founders to cover its bills. All 3 checks point the same way: rights only to what BrizoConsol is worth, not to the oven or the invoices directly. That makes it a genuine joint venture, not just because it's a company, but because the legal form, the contract, and the facts all agree. Change any one of those, say, add a clause where both founders personally guarantee BrizoConsol supplier debts, and the same company could tip into a joint operation instead. The label follows the substance, not the certificate of incorporation. If this cleared things up, the full course goes much deeper: journal entries, equity method mechanics, and how BrizoConsol handles both types automatically. You'll find the complete course, and everything else in this series, on BrizoConsol Academy on Udemy. Link is on screen and in the description. And if you're consolidating real entities, not just café roasteries, BrizoConsol is built to handle exactly this: joint operations, joint ventures, subsidiaries, all in one platform. Come see it at BrizoConsol.com. Thanks for watching. See you in the next lesson.